Welcome to the Riskwiser Zone, the show where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Lewis, and we're excited to have you join us today. We're starting off with a fascinating conversation about the current state of the Indian market. Recently, Ajay Tyagi shared his insights on the market trends, and it's worth taking a closer look. According to Tyagi, the Indian market is currently under-owned by foreign institutional investors, which could be a comforting factor for long-term investors. Tyagi notes that the foreign institutional investors' ownership in India has fallen to around 17–25%, a level last seen in 2013. This decrease in ownership is largely due to sentiment-driven negative impacts from the India-US treaty and tariff uncertainties. However, with valuations correcting and fundamentals potentially improving, the case for India strengthens. When it comes to earnings, Tyagi believes that if earnings growth returns to trend levels, it could be the final trigger to bring foreign institutional investors back into the Indian market. This could potentially lead to an increase in foreign institutional investors' ownership, which might have a positive impact on the market. As a long-term investor, it's essential to remain patient and focused on the fundamentals. Tyagi advises investors to preserve capital for the right opportunities, avoid chasing fashionable sectors, and not sell quality businesses based on short-term trends. He emphasizes that patience will be rewarded if you've done your fundamental research well and are focused on long-term drivers. We'll continue to explore these ideas and more in our upcoming segments. For now, it's clear that the Indian market is at a critical juncture, and investors need to stay informed to make the most of the opportunities available. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of banking and finance, where UBS has been making some notable moves. The firm has been updating its outlook on several bank stocks, giving us a glimpse into the current state of the industry. Let's start with East West Bancorp, where UBS has retained its neutral call despite trimming its target price to $125. The company reported a 21.5% year-over-year increase in net income, driven by an 11.9% growth in net interest income. This was largely due to the expansion of its net interest margin, which rose 17 basis points to 3.41%. East West Bancorp's loan book also saw a 6.0% year-over-year increase, reaching $56.9 billion. In contrast, UBS has a more positive outlook on South State Bank, where it maintained its call with a slight adjustment to its target price. The bank reported strong earnings, with net income growing by 24.1% year-over-year. Its net interest income saw an impressive 13.4% increase, driven by a 20 basis point expansion in its net interest margin. South State Bank's loan book also grew by 5.0% year-over-year. Lastly, Commerce Bank shares caught UBS's attention, with the firm maintaining its neutral call and adjusting its target price. The bank reported a 10.3% increase in net income, driven by an 8.2% growth in net interest income. Its net interest margin expanded by 15 basis points to 3.33%, while its loan book grew 4.0% year-over-year. It's essential to consider multiple perspectives when evaluating these bank stocks. While UBS has provided its outlook, it's crucial to remember that individual results may vary, and investors should conduct their own research before making any decisions. As we continue to navigate the complex world of banking and finance, one thing is clear: staying informed is key. Whether you're a seasoned investor or just starting out, understanding the latest developments can help you make more informed decisions. Welcome back to the Riskwiser Zone. As we wrap up today's show, I want to bring to your attention a fascinating development in the world of artificial intelligence. Anthropic has just released its latest large language model, Claude Sonnet 4.6, and the results are impressive. According to Anthropic, this new model has a 1 million token context window in beta and has performed well on internal safety tests, showing a low tendency to hallucinate and engage in sycophancy. What's notable about Claude Sonnet 4.6 is its benchmark performance, which surpasses not only its predecessor, Claude Sonnet 4.5, but also other models like Google's Gemini 3 Pro and OpenAI's GPT-5.2 in certain tasks. In fact, many developers with early access to Claude Sonnet 4.6 have preferred it over even Anthropic's own Opus 4.6 model. The pricing of Claude Sonnet 4.6 is also worth mentioning, starting at 3 per million input tokens and 15 per million output tokens, making it a more affordable option compared to the Opus 4.6 model. While this new development holds promise for the AI community, it's essential to approach such advancements with a critical eye, recognizing both the potential benefits and risks associated with large language models. As we consider the implications of Claude Sonnet 4.6, it's crucial to remember that the AI landscape is constantly evolving, and investors should be cautious when navigating this space. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.